Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone, and welcome to Through the Noise podcast. This is Michelle, and I'll be the host for today's session. Before we start, may I wish you all a happy Chinese New Year on behalf of the Standard Chartered CIO office. May you all have a joyous and prosperous year of rabbit. This week, we have seen a resurgence in financial market ahead of the Fed and the ECB meetings next week for the first time this year. Despite markets showing more signs of a potentially easing from a continual rate hike, we believe it's too soon for the Fed and especially the ECB to declare victory as their job markets remain hot. So here comes the question: how should we position ourselves in the current macro backdrop? To discuss this question and more, I'm glad to have here with me today Mr. Fook Hien, our Senior Investment Strategist. Hi, Fook Hien. Thank you so much for joining us today. So in your weekly, you write about some complacency in markets. Could you explain a bit more? Where do you see this complacency and what are the investment implications?
Yeah, thanks very much, Michelle. We have seen a strong rally so far this year, including in European and Asia ex-Japan equities, also in the Asia local currency bonds, European high-yield bonds, industrial metals, gold, and the Aussie dollar. So we feel there's been three broad themes driving this strong rally. One is the warm winter in Europe. This is reducing the risk of an energy crisis there. And the two is rising expectations in the US that we could see an early pause in the Fed rate hikes as inflation is easing. And the three is easing of mobility restrictions in China. This has been helping the economy there. However, our own indicator of investor diversity suggests that investor positioning has become crowded in most assets that have led the rally this year. And so this raises the chance of a reversal. And we also have big events coming up like the Fed and ECB meetings next week at the start of February. So with the Fed, the market is expecting a 25 basis points hike now in February and in March before a pause, or a so-called terminal rate of 4.9%. But we think the Fed officials have been sounding resolutely hawkish. So until we see clearer signs of the job market and service sector wages decelerating. Hence, one investment implication is that we would refrain from chasing the rallies, especially with crowded positioning and before the key central bank meetings. So we remain watchful for signs of the Fed preparing to cut rates before turning more constructive on equities and other risk assets. So at the moment, we still see the Fed cutting rates in the H2 or second half of this year. And for now, we believe a diversified income portfolio remains the best way, safe way for investors to position themselves. This would be for investors to capture the attractive yields which are available in your quality income assets.
Got it. So maybe let's look into specifically equities. Just staying with US equities now, the earnings season is also ongoing. So would you give us some updates on how it is shaping up?
Yeah, sure. So about 25% of companies in the S&P 500 index have reported so far, and with mixed results, we think. So according to Refinitiv, 69% of these companies have beaten expectations, which compares to the long-term average of 66% beating expectations. However, earnings growth for Q4 is still expected to be negative at minus 2.7%, and this estimate is revised down from minus 1.6% expected at the start of the year. In fact, earnings estimates for every quarter in 2023 has been trimmed since the start of the year, as the analysts are reassessing the likelihood of a growth slowdown and companies are providing softer guidance. So for this year, 2023, the consensus expectation stands at a 3.1% growth. This is revised down from 4.4% expected at the start of the year. But while earnings expectations are being revised down, revenue expectations have been stable compared to the start of the year at a 4.2% growth for Q4. So this points to a weakening in margin expectations as the earnings season is progressing. And sector-wise, the US financial sector is the most advanced in reporting, with over 50% of companies having reported. And Q4 earnings growth is negative for the sector as credit provisions increased, and the provision releases that we witnessed in 2021 were not repeated. The credit provisions, however, have been largely as expected, and the financial sector is expected to benefit from a rising interest rates this year, driving an expected 12% earnings growth. So the coming weeks, we'll see several mega cap technology and internet heavyweights reporting earnings. Technology is the largest sector in the US equities, and it's expected to see an 8.6% decline in Q4 earnings. We have also seen warnings of a slowdown in cloud computing as the growth rates normalize from the acceleration witnessed during the COVID 19 pandemic. There are also signs of a weaker corporate spending on your software and other technology products. So the tech companies have been reacting with job cuts, which is a rare move after many years of growth in the sector. So the tech sector is expected to grow its 2023 earnings by 2.6%, slightly below the broader market. And overall, we have a neutral view on the financial and technology sectors. We expect them to perform in line with broader US equities. And as we see a high likelihood of a recession in the US, we do prefer your defensive sectors such as healthcare and consumer staples. And we are also overweight the US energy sector, where we see strong cash flows and attractive valuation.
Got it. So if we look at some other sharp moves in the market recently, we have also seen a sharp decline in the US dollar and a strong rally in gold. Can you talk about the outlook of the US dollar and also the gold, please?
Yeah, sure. So since November last year, we have seen a sharp decline in the US dollar index or DXY. This has been driven by the markets pricing in fewer rate hikes from the US Fed and more hawkish stance from the ECB. And so this reduces the US dollar's expected interest rate advantage. However, ahead of the Fed meeting next week, we see the risk of complacency in markets, with multiple Fed members still sticking to their hawkish stance. There is a risk that any hawkish surprise in the FOMC meeting, this could lead to a short-term bounce in the US dollar, especially with skewed positioning right now and stretched technicals. However, we do expect a hawkish ECB. This would cap any near-term bounce in the DXY to around 103. And then with gold, prices have rallied sharply, driven by your lower US government bond yields and the recent decline in the US dollar. However, our proprietary indicator for market diversity, it is signaling that the recent rally has led to stretched technicals for gold. Hence, we see a higher risk of consolidation or even a pullback over the next few weeks for gold. So we would prefer to wait for a pullback towards the 1840 area before adding further exposure to gold.
I see. So, apart from gold and dollar, perhaps you can also touch on the oil too. It seems like there have been some volatility, but also moving up recently. Do you see this rally as sustainable?
Yeah, sure. So the WTI crude oil, it declined sharply in the first two trading days of this year before recovering steadily in the past few weeks. So the steady climb in oil prices can be attributed to one, a rebound in energy demand in China following the government relaxing mobility restrictions there. And also China's growth spill over to Asia is also helping to boost oil demand from the region. A second is an improvement in growth sentiment with positive economic data surprises in Europe and in China. And a third is a signs of falling crude exports from Russia due to existing sanctions. So supply is getting tighter. So we believe the crude rally can continue to grind higher in the short term. So on the supply side, the additional cap on the price of Russia's fuel exports, effective from 5th of February, is likely to reduce diesel supply further. And the upcoming OPEC Plus meeting on the 1st of February is unlikely to see any tweaks to the current policy. Meanwhile, on the demand side, China's reopening will remain supportive of demand. And from a technical perspective, the WTI crude oil is breaking out from a 7-month long downtrend since June of last year. So this could see prices move higher towards $83.
Got it. Thank you so much, Fook Hien, for your valuable insights and comments. This is all we have for today. Thank you so much, listeners, for joining us. And once again, wishing you all health, happiness, and prosperity in 2023.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.